we'll take a look at these also right after we finish with the United States dollar against the yen. Right, so finally we would want to note that actually 10-year treasury bond yields today are 1.6%. The bond markets are closed in the United States because actually Columbus holiday, even though the equity markets are open, but only the bond markets are closed. So actually the last high for bonds was at 1.7, so we're very close to that high. There probably will be a breakout above 1.7, of course, if this trend continues, and that's where we'll start with our analysis today. The United States dollar against the Japanese yen is most, of course, affected by the current rise in bond yields. So looking at the monthly chart, we have been looking at this several times. All right, over the past weeks, we are all now aware of leading diagonal. There is a valid breakout now, and there is definitely a confirmation of that valid breakout, as we will see on the next coming chart. Our most immediate targets are going to be 114.56 or 114.6. Okay, we just also expect after that, I believe this is 118.23. Let's take a look at that confirmation. This is what we're seeing now on the monthly chart as of early this morning. We're beginning to have actually a bounce on the zero line on the monthly. This could be, of course, a very strong signal, and the last time we had this was over here during the Trump administration's victory, I believe, or around that time. No, that wasn't during the Trump administration's victory. Okay, so the last time we had that was back in 2000 and over here, back in between mid 2013. Okay, at that point, of course, there was still financial easing programs going out of the credit. That was, I believe, the second stimulus package issued by the Federal Reserve after 2009. It's a valid signal again this time around. So we're looking here now. Today, we seem to have broken out of this neckline. The correction is definitely complete with that 4C. We have broken out of a ledge, and this kind of signal would lead you to believe that we're going into a degree 3 trend. Of course, the higher the time frame, the better. So if we're really going to be able to confirm that signal on lower time frames, so this is the monthly chart, then we should be moving up into this Elliott channel. On this Elliott channel, our next target is really going to be 115 and of course 114. After we do this target, we expect retraction into the Elliott channel and then moving to the neckline itself, which is 119. Ultimately, targets here are actually should be contained by this Elliott structure that we have in dashed green. All right, so if this is a wave 3, a wave 5 would truncate about, if we're doing now wave 5, would expect that the current breakout is a wave 5 on the monthly chart. So if we're doing wave 5, you are at least 27.2% below the top of wave 3. This takes you to 124. Ultimately, we expect at least to do the first resistance here, which is 119 again. All right, let's take a closer look at the trade management itself and how we could get into the market now. This is the current 4-hour chart. The momentum is positive, of course. There is actually a confirmation of a degree 1-2 signal here. We're quite sure of that. We're not showing it on our analysis, but it is showing on the 4-hour charts and on the 1-hour charts. So this is now confirmed that there's a breakout of a degree 3 inside of, on the 4-hour chart. This is that Elliott structure. We have it here. This is of course a level 2 and this is a level 4, and we're going up. This is a higher degree now, level 3. There has been a 4A, a 4B and a 4C. This wave 5 here has been demoted to become 4B, and there is a 4C. We're going now into 5 swings that will be labeled here in this yellow color. This is going to be wave 5. First primary target is going to be at least, of course, 138.2% above level 3, which is 114.74 or 115. All right. So given this current structure, we have, of course, broken out of that inverted head and shoulders. This head and shoulders is actually bullishly translated, meaning that the current shoulders on the left has been raised above the neckline. There aren't going to be any more shoulders down to that neckline because we have already broken above that dashed neckline. Having broken above level 1, this is now higher degree 1 and this is higher degree 2, you would expect that you should not, this market probably will only be going up. you want to take entries on the 5 and 15-minute charts. Any negative momentum that we see there, we should be buying into. Again, this is a very conservative target here, 114.7. You're probably looking at 118 and 119 for this kind of move. Now is a degree 3, this same label here, but degree 3. So we have broken above that level 1 now, definitely. We are now doing 113. This was at 112.25. You're not going to be seeing, probably we're not going to be seeing this level again. That's why we have this strong green arrow here that we will be buying into this Elliott structure. There's an internal, there should be showing an internal Elliott structure here on the 1 hour chart that we should be buying into. These red arrows here show you that the market shouldn't fall below this level, and this is our really our ultimate stop. We're looking at an ultimate stop of 111.5 now, and even 111.8. all right, even spikes, that's the most that they will be doing. All right, let's take a look at the 1 hour chart. This of course has been amended. Okay, so this is the segregation on the 1 hour. This would lead that this is the current internal degree 1-2. The market should not fall below 111.9 or 112. Okay, when we go live on the market, we would want to actually do Elliott retractions into the current growth wave. Either on the 1 hour, it will be, you will have to wait for a higher degree correction, so it's better to use lower time frames, 5 and 15 minutes. Again, the stop here is, of course, here it's a bit delayed. Below level 1 altogether is going to be 118. Whatever we buy into that structure probably will be around 112.6, 112.7. We'll go live and take a look. We'll have a stop at 118. We're going, of course, for 114, ultimately for swing traders, that is. And with the first target is 113.85. We're going for 114.8 and 114.6. Okay, so we'll be using, usually we'll be taking entries on a 5-minute chart. This is, or maybe 15-minute chart, really is the best, probably not only the best, probably the only available entries we'll be getting into the trend if bond yields will be spiraling out of control. We have to take that into consideration, that it is not a matter of trend now, it's a matter that actually if there will be rampant inflation, or if the market will discount that there will be rampant inflation, we'll find a very strong rise in bond yields. The United States dollar against the yen will rise very strongly. So this may happen, this may not happen as quickly as we anticipate, but if it does happen, we have to be prepared. So we have to be into the market. That's why we have this stop. We would want to buy market, actually have a stop at 118, 111.8, 111.8, and let the trade run, because if this is really going to spike higher, you're going to be seeing levels of 117 and 116 and 118 quite soon. In order to make technical entries, we'd have to use actually to buy into negative momentum on the 5 minutes or the 15-minute chart. So the last signal we got was around here, 112.2. There is now an internal degree 1 here, and this is a degree 3. Market will probably not fall below the stop level here, 112.24. Best entries are going to be, we could leave limit orders at 112.7, 112.4. If we buy 2 minutes or even 3 minutes, or even I would think you could go as high as 4 minutes. All right, only for 2 minutes you're looking at $200 risk, or 2%. If the stop is going to be 111.8, it's shown here at 111.7. Again, we're going at least for 114.7. We would consider to let the trade run. Let's go live and take a look. So it's running off, like we were saying. Maybe we shouldn't have spent so much time talking. We're just doing all the talk to show how important this is going to be. This is going to be a secular trend. You remember, we're always talking about that Christmas rally, Santa Claus rally that they keep talking about. Okay, so this is it. I think probably this is this year's Santa Claus rally. Okay, so from what we're seeing here, so this is a RAM market, a runaway market, or a rapidly advancing market. We have talked about this several times. This is really a running away market, and probably, and therefore you just use the 1 minute chart, even not even to make an entry, but to make a stop actually. So we have here, of course, an internal degree 1, 2, definitely. You have a neckline here. You have, of course, a lower degree 1, 2. It's clearly shown on the 1 minute. and this means that actually your first level, internal 1 and internal 2, is this, and this is a 3. Now if this market, this is a very small chart, it's only a 1 minute chart, yes, but it is expected this is the best that the market will give if it's really gonna be a runaway trend. So we have to keep in mind this is fundamentally impacted, so it's not really a technical entry more than just a fundamental entry. Currently these are the best levels. We would expect to see 113.15, 113.10, 113.05, or just 113. So it's really now everyone under risk preference. You're looking at again 113.15, 113.10, and 113.05. Technically speaking, you below this level, below the neckline, you will be getting a higher degree correction, or an intermediate term or short term correction. All right, we just checked where that would take us. It would take us on the 1 hour chart to 112.7. We have here a breakout of that neckline at 112.87, and the next neckline comes in at 112.6. So of course 112.7 is right in the middle. So we could consider to buy half size right now as the market moves lower. Maybe our best entry is going to be 113.15, 113.10. We would add to that, it's now everyone under risk preference. You would add to that at 112.7 or 112.4. Check these levels on the analysis. Okay, so we have here, even on the 5 minute chart, it's showing at 112.6, 112.7 inside of that 5 minute Elliott structures. So we would want to have half size at 113 now, 113.05, 113.10. all right, and add another half size between 112.7, 112.4. If you're buying 4 minutes, then it's 2 minutes upfront, 113.10 or 113.05. Of course, everyone would have to do their own due diligence and be comfortable with the risk. And then we add another 1 minute at each of these levels. You would have to work out your risk analysis so that's not more than 3.6% or 3.4%. The stop is 111.7 or even 111.8. We're looking at that stop there here. And the point. All right, let's move on to other issues. Okay, all right, we'd want to do the other sterling yens, the other sterling pairs, and the most, of course, important of these is the sterling yen. This has also broken out higher. There is possibility, actually, again, by analysts, there's gonna be some kind of strong hyperinflation, or what they call stagflation in the UK due to demand problems. Of course, the UK is gonna be hard hit by the current fuel crisis. They're going into winter. There's a problem with lorry drivers. There's actually originally there is supply problems with liquefied natural gas. It comes from Russia, and the supplies are not really that what you would call consistent.